In this series of videos, we're going to talk about the choice of financing. That is, how does management decide how much money they ultimately want to borrow relative to how much money they've gathered from shareholders? So we're going to look at several things. We're going to talk about break even and how leverage impacts the break even point of the company, how we measure and assess leverage itself. We'll talk about the theories of capital structure. We'll look at a spreadsheet approach to understanding how capital structure will be affected by choosing different levels of debt. And in the end, we'll talk about maybe some alternative types of capital structures and how it ultimately relates to the value of the company. So leverage is the impact that fixed costs have on returns of shareholders. Higher leverage typically results in higher returns, but more volatile returns. So the fixed costs that we're talking about can come from a couple of different perspectives. They can come from operations and they can come from financing. So the idea of fixed costs is that they are fixed. They do not change once they are acquired, and it doesn't matter whether things are happening are good or bad, they're always going to be the same. The basic concept of leverage is that leverage magnifies both returns and risks. And since it's affecting returns and risk, it also has an impact on the value, the price of the company. Now, the process that we're going to talk about here is capital structure. That is the mix between long-term debt and equity for the company. So there are three basic measures, if you will, of risk that we're going to talk about with respect to leverage. The first kind of operating leverage is those fixed costs that are associated with running the business. And it's, as we'll see when we look at some formulas a little bit, it's a fairly straightforward formula, but operating leverage measures business risk. Financial risk is concerned about the relationships that are created by how we borrow money or the amounts that we borrow. And how the formulas work is just the relative differences, if you will, between different line items in the income statement. Total leverage is ultimately is the combined effect of operating and financial leverage. And again, it looks at how revenues and earnings per share relate together. So as we work down the balance sheet, business risk or operating leverage is the relationship between sales revenue and EBIT or operating profits. Financial risk or financial leverage is the relationship between EBIT or operating profits and earnings per share. And then total leverage is the entire income statement, or looks at the relationship between sales revenue and earnings per share. So if you kind of think about how the relationship in an income statement is created, operating leverage is the top half of the income statement. Financial leverage is the bottom half. And again, total leverage is the combined balance or effort of those two things. So let's think about initially starting and talking about operating leverage. And the first concept we want to talk about here is something referred to as break-even analysis. And I'm sure you may have seen or studied this in some other courses, other programs, but essentially we want to determine the operating break-even point. That is, what level of sales do we need to achieve an EBIT equal to 0? So we need to figure out, if we look at cost of goods sold and operating expenses, we do need to divide them into fixed and variable operating costs. This is much easier done within the company than from the outside. And again, fixed costs are those that for a given period, they are the same, they don't change, but variable costs change based on sales volume. So our first formula here, we want to solve for Q. So if you look at the equations for operating profit, it's price times quantity minus fixed costs minus the variable cost, which is variable cost times Q. So again, if you simplify that formula, EBIT equals quantity times P minus VC. Now that's actually a very important number. That's what's referred to as the contribution margin. For every unit you sell, how much of the profit is left to cover fixed costs? Because once fixed costs are covered, that's the break-even point. Now this contribution margin is the contribution to profit for every unit that's sold after break-even. Now if we solve for Q, what quantity do we need to sell to get to break-even? We have the formula that has the fixed cost divided by that contribution margin. So here we have this company, they have fixed operating costs of $2,500, sales price $10 per poster, and the variable operating cost $5 per poster. Using the formula, we see that we need to sell 500 units, and of course, identified here also is the break-even unit in units is 500 units. So again, what we find here is we can identify the break-even in units. That will give us an EBIT of 0. And then there's actually even in this case a break-even in sales, in this case $5,000. And again, if you take the price per unit of 10 times 500, $5,000 is the break-even point. So if we look at this graphically, what we find is the green line here is fixed costs. The revenue, right, is the line here, right? So the total costs is the fixed cost plus variable cost. So as units go up, we have increased line here. And where the total revenue intersects with the total cost, right in here, that's roughly 500 units. That is the break-even point. So before the break-even point, we are losing money. That is revenue. Total revenue is less than total costs. And to the right or above the break-even point, we have profit that's being made. So the formula for operating leverage then utilizes or thinks and uses this basic concept of operating leverage. If you look at the operating profit of the company, it's Q times the contribution margin. If you divide that by Q times the contribution margin minus the fixed cost, that's what we refer to as the degree of operating leverage. It is a measurement of the business risk of the company. The bigger the number, the greater the risk. Now, if this company had 0 fixed costs, then the degree of operating leverage would be 1. So it cannot be less than 1. So anything more than 1 then implies that there is some operating risk in the way the company is running its business. So the more fixed costs we have, the greater the degree of operating leverage. Now we can also use financial statements. However, it does add a little peculiarity to this, since one or both of these numbers could be negative. We could have a negative change in EBIT and a positive change in sales, so the degree of operating leverage could actually be negative. But if we think essentially about the absolute value, this again can give us a clue as to what the operating risk of the company is. So if we go back to our graph, or worksheet, excuse me, on break-even analysis, we have this company. We now know that their fixed cost of operation is $3,000. $4 at the, excuse me, we've eliminated some sales positions, we've made some changes. So it's going to reduce our variable cost from 5 to 450, but there's going to be an increase in fixed cost from 25 to 3,000. So how does that affect break even? Break even goes from 500 to 545. And in this case, you could also see that it will calculate the degree of operating leverage. And for this company now, the degree of operating leverage is 2.20. They'd have EBIT is $6,955. Now that's positive because they're selling 1,000 units. Since they're selling more than break even, they're going to show profitability for the company. The degree of financial leverage, again, is a similar kind of concept. As leverage increases, it magnifies potential returns. So in this case, we're looking at EBIT divided by the operating profit minus any interest expense, minus any preferred dividends that are ultimately weighted by the tax rate that's paid. So again, this number, if you had no fixed costs in financing, interest would be 0, preferred dividends would be 0, degree of financial leverage would be equal to 1. And as this number increases, that must mean that the financial risk of the company is also increasing. Again, we can also get this right from financial statements instead of the internal parts of the company, the financial statements. We can use this percentage change version. Again, the one peculiarity is we want to use the absolute value rather than just the percent change divided by the percent change. What this ultimately then leads to is total leverage. What is the total combined effect of the leverage in operations and the leverage in finance? And again, we plug this in our formula, right? So the total degree of total leverage, it really is just the variables that we've been talking about so far. We can obviously do that from the financial statements, but I kind of like to think about this degree of total leverage with a little bit different kind of a formula. The degree of total leverage is the combined impact of operating leverage and financial leverage. However, the mathematical operator here is multiplication. So frequently people will say, your business is whatever your business is. There is business risk. And you can add to that risk by adding your financing decisions. Well, that's really not totally correct because it's not an additive function, it's a multiplicative function. If you remember, both of these cannot be less than 1. So the degree of total leverage, again, can also not be less than 1. And the combined effect here will drive the overall riskiness of the company. So again, we have this company, have sales of 20,000, units are $5 per unit, variable cost $2 per unit, fixed cost 10,000, interest 20,000, preferred stock dividends are 12,000, they're in a 40% tax bracket, and they have 5,000 shares of stock. So if we input this into our spreadsheet, what we will find out is that the break-even in units is 3,333 units. They are actually selling 20,000 units. So they're absolutely going to be profitable. What we want to look to the right, though, is we want to look at the impact. The degree of operating leverage is 1.2, financial leverage is 1.8, and the degree of total leverage is 2.16. So again, now we can make some comparisons to maybe some competitors or somebody else in our industry. It might be important for management to understand these risks. If they want to manage the riskiness of the company, right? Reducing operating leverage but increasing the amount of debt we have might not bring together a decrease in the riskiness of the company. So again, this idea of leverage and how managers decide to run the company ultimately has an impact on the profits of the company. It has an impact on the riskiness of the company. So in the next video, we will talk a little bit more about the theory about how managers now should decide to finance the operations of the company. So we'll sort of be looking at here the components that will ultimately create this degree of financial leverage.